There are many different types of assets that you can invest in. In this video, we're going to look at the main 5 asset classes, what they are and what their characteristics are. I'm Anthony and we're talking money. Now, before you all start saying that there's more than 5 asset classes, you're absolutely right. There are loads and probably many subsets of each too, but we're just going to look at the main 5. If you think of any extra ones, put them in the comments below. Right, first off, the term asset class is a little vague, but for the meaning of this video, I'm going to define an asset class as a distinct financial tradable asset. So first off, stocks and shares. Now, strictly speaking, stocks are different from shares in that shares are a slice of ownership in a particular company, whereas stocks refer to companies in general that are traded on a stock market. That is why you buy shares in a company but have stocks in your portfolio. But anyway, that's just being pedantic. In everyday language, we use stocks and shares as the same thing. This is probably the best known asset class and is characterized by having 2 distinct parts to its makeup. First of all, its price, and secondly, its dividend. The price gives the market capitalization of a company and the dividend gives the yield. Movements in the price and yield give the total return, and this asset class is the cornerstone of most investment portfolios. Next on the list is bonds. Now, you can divide bonds as an asset class immediately into 2 groups straight away: government bonds, also known as gilts, and corporate bonds. Essentially, they operate the same way, in that a bond is a form of borrowing in which the issuer gives an interest to the buyer of the bond. There is usually a payback date, but not always. You can have open-ended gilts, for example. A date that the amount is borrowed is paid back by the issue is called the redemption date and can be many, many years after the date it was first issued. The time in between the issue and the redemption, the bond can be sold onto other people and traded in the marketplace. The issuer pays the interest to the person whoever holds the bond at that time, say, I don't know, 10%. The price that the bond can be sold at is dictated by the market, and so the return or yield on the bond is dependent on whether the bond is sold at above or below the issue price. Higher the price, the lower the yield, and likewise, the lower the price, the higher the yield. Now, the distinction between shares and bonds is what moves the price. With shares, it will be the market's opinion over what the company is worth in the short or long term. With bonds, it's the expectation of future interest rates that changes the price. After all, the only value in a bond is its yield. The redemption value is the same as its issue price, so there's no capital appreciation. The only thing someone values in a bond is its yield. The return is compared continually with the interest rate expectation for next month, next year, next 10 years. If the market expects interest rates to move higher, then the bonds are sold to drive down the price, which in turn increases the yield. Now, any economic data that comes out makes people in the market take a view on how that might impact interest rates. So for example, higher inflation rate might mean that the government may have to increase interest rates to cool the economy, or higher unemployment rates may mean that interest rates may have to be reduced to increase the economy. Okay, I know that this is an oversimplification of bonds, but put in the comments below how you see bonds working and how they fit into your portfolio. Right, the next asset class is property. This can take the form of direct investment in houses, office blocks, land, forestry, etc., or investment trusts that themselves own properties. These are known as REITs. I never know how to pronounce that actually, but it's REITs, which stands for Real Estate Investment Trusts. This can be a less risky way of investing in property, as the trust spreads its risk over many properties rather than just 1 or 2. Like shares, there are 2 elements to property or REITs: the value and its yield. How property behaves in price is a little bit of a halfway house between shares and bonds. If you own a property yourself, you know that the price is hugely dependent on the health of the economy and interest rates. On a personal level, it boils down to affordability, and on an investment point of view, it's no different. Can that company or supermarket afford the rent on that property, or does it have to move to cheaper accommodation because its profits or cash flow just can't afford it? On the flip side, does the landlord lower the rent because they can't see a replacement anytime soon, the economy is tanking, or do they need to increase the rent because the cost of borrowing is so high and just leaving money in the bank gives a better rate of return? In summary, property is affected by the state of the economy and the current and future expectation of interest rates. The next asset class is commodities. Commodities are basically raw materials that are needed to make things, everyday things. They include iron, copper, oil, silver, gold, platinum, hundreds of other materials. They are largely independent of overall share and bond returns because, unlike them, they are actually real assets as opposed to financial assets. A lump of silver is something physical you can hold and is used to making objects that are sold. And because they are so important in the price of everything that's made from them, commodities are often seen as a hedge against inflation. Aside from this hedge against inflation, commodities also provide a better diversified portfolio that can offer returns when other asset classes may be failing. In the 45 years to 2015, commodities were shown to have very low correlations with shares, almost no correlation with bonds, and a very high correlation with the consumer price index. The recent rise in commodity prices could well be a market indication that inflation is just around the corner. The final asset class in this list is currencies, and of course this can be subdivided into the traditional nation currencies like the dollar or the pound. Most currencies, but not all, are not now backed by a commodity like gold, which means that central banks are much freer to control the levers of the economy because it can print more money. This can lead to inflation that erodes the value of the currency, but in theory the central bank does have some control over the value of the currency. Cryptocurrencies are another division of this asset class, and some would argue with good reason that cryptocurrencies are a separate asset class altogether. However, all currencies have one thing in common. They are held as an asset class and have financial worth only if compared to another currency. Of course, you can use the currency in the domestic country like dollars in America or pounds in the UK, but this is using currency as cash. Holding currency as an asset class really only makes sense if it's in context with its relative value compared to another. So for this reason, currencies are always priced as pairs, i.e. dollar to sterling, euro to yen, Swiss franc to bolivars, etc. And since you can gain or lose money by seeing a fluctuation between the pairings, currencies are often seen as a zero-sum game, i.e. one side goes up by the same amount that the other side goes down. It doesn't matter if both economies do really well and both currencies appreciate against everything else. It boils down to the currency pair in question. Currency trading therefore tends to be done on a much shorter time frame and is a favourite amongst day traders who hope to be on the winning side of any fluctuation. So there you go, these are my 5 main asset classes. I appreciate that there are many more, such as venture capital, hedge funds, collectibles like wine, paintings, whiskey, possibly, and cash that we've touched on. If you've got more, then put them in the comments below and add to them. Anyway, I hope you've enjoyed this video. If you have, please subscribe, hit the like button and the little notification bell, and I'll see you in the next video. I'm Antonio, and as always, we're talking money. Bye for now.